SPY is opening the recap with a fresh all-time high, so the bullish side still has the first shot here. This is also the 15th closing all-time high of the year, and that tells me buyers are still willing to press risk even after a huge rebound from the prior sell-off setup. Last time, the S&P 500 was stuck in risk-off repair mode after the oil shock. Now that structure has flipped into breakout mode, but I would still treat it as a breakout that needs confirmation, not a blind chase. The level that matters now is the upper resistance area near 737.6. If SPY can push through that zone and hold it into the close, the breakout structure stays alive and continuation remains the base case. If price gets rejected and falls back under the breakout area, the first warning is a move toward the 726.4 support zone, where the market has to prove this is just cooling off and not a failed breakout. Momentum is strong, but it is also hot, so I want clean closing strength before trusting the next leg higher. QQQ is the leadership piece behind the SPY breakout, and buyers are still in control. The Nasdaq 100 has closed at a fresh all-time high, with the 11th closing all-time high of the year, so growth is not just participating, it is leading. Last time the tape was about pressure from oil, yields, and the dollar. Now the structure has flipped hard enough that the bullish side still has the edge, as long as price keeps holding the breakout instead of fading back into the old range. The risk is that QQQ is now stretched into a conservative rising wedge, with resistance near 711.23 and support near 692.99. If buyers can hold above wedge resistance, the bearish wedge red weakens quickly and growth leadership can keep carrying the market. If the lower wedge boundary gives way, the first clean downside reference is that 692.99 support area, and that would tell me this rally needs a reset before the next push. That matters before we move into yields, because higher rates are the most obvious pressure point for this kind of extended growth setup. The 10-year yield is the pressure point for the growth rally now. TNX is sitting in the lower half of its current structure, but it is still holding above the 50 days average, so I would treat this as a bounce zone first, not a clean breakdown. That keeps some pressure on the SPY and QQQ breakout story, because if yields bounce back toward the middle or upper side of the range, stretched growth can lose some air. A clean close below this support area would weaken the rate pressure argument quickly. The short-term setup is compressed, because TNX just printed an inside day. That usually means the next move matters more than the current candle, so I want to see which side breaks first. If yields break higher from this tight range, the market has to reprice the Fed and valuation pressure again. If the inside day breaks lower instead, that would give equities some breathing room before we move into the oil risk chapter. Crude is still the macro swing factor, but the chart is no longer pressing straight higher. CL equals F closed at a fresh 10% plus pullback low on Friday, with the drawdown around 11.4% from the swing high. That cools some of the inflation pressure that was feeding into yields, but it does not remove the geopolitical risk. If oil keeps sliding, equities get some relief. If war headlines bring buyers back fast, the rate pressure story can come back with it. The decision point is whether crude can hold the lower end of this structure. Price is still above the 50 days average, so I would treat this as a support test first, not a confirmed breakdown. If that area holds, a bounce back toward the middle or upper side of the range is still the cleaner path. If crude closes cleanly below support, the bounce case weakens quickly, and that would take some heat out of the inflation trade before we move into Nvidia and AI leadership. Nvidia is where the growth rally either gets real leadership or starts to thin out. MACD has crossed back above its signal line, the histogram is positive, and price is above a rising 50 days average, so short-term momentum is turning back toward buyers. After crude cooled off and yields stopped being a one-way pressure point, this is exactly the kind of mega cap setup that can keep the Nasdaq bid alive. If MACD holds above the signal line and price can break resistance, upside continuation becomes more likely. The trade path now comes down to whether Nvidia can stay above the breakout area. Price is near the upper end of the current structure, with both the 50 days and 200-day averages below it, so the setup still reads more like continuation than rejection. If buyers hold this area, AI leadership keeps supporting the broader risk-on case. If price falls back under the breakout area, the move starts to look like a failed break, and that would weaken the market before the economic calendar risk hits next. The next test is the calendar, and it is heavy enough to decide whether this breakout gets confirmed or cooled off. Tuesday brings CPI, with headline month-over-month expected at 0.6 after 0.9, headline year-over-year expected at 3.4 after 3.3, and core CPI month-over-month expected at 0.4 after 0.2. If inflation comes in hot, yields can pressure the same growth leadership we just saw in Nvidia and QQQ. If the data cools, buyers get a cleaner chance to defend the breakout structure instead of immediately fighting another rate shock. After CPI, the market still has producer prices on Wednesday and retail sales on Thursday. Retail sales were previously 1.7 months over month, and the control group was previously 0.7. So this is where traders check whether consumers are still strong enough to support earnings without forcing the Fed into a tougher stance. Strong growth with sticky inflation could keep rates elevated and make the equity breakout harder to trust. Softer but controlled data would be the cleaner setup for a pullback that stays corrective rather than turning into a failed breakout. Here is the final read. The market is strong, but it is not clean enough to chase blindly. Resistance cluster around 737.6 is the whole decision area right now, and buyers are pressing directly into it. Again, price can keep pushing higher, but I would not treat this as confirmed until it holds that area into the close. RSI at 75.3 says momentum is still strong, and MACD is holding constructively above the zero line. Upper Bollinger area is also where price is trading, with stochastics already hot near the top of the range. That is why the tape can be bullish and stretched at the same time. Open gap below around 725 to 727.8 is still unfinished business underneath price. So the question is simple, do we get the gap and go, or do we fill the gap first? In the prior video, the broad market was still dealing with oil shock pressure and a weaker risk tape. Now that structure has flipped into record high breakout mode. The macro driver does not replace the level. If inflation or rate pressure comes back, it changes the probability around the same decision zone. Again, the market has earned the bullish read, but it still has to prove it by closing strong, not just spiking intraday. From here, I am shifting from what already happened to the actual scenario map for next week. Base path still points higher as long as buyers defend the breakout structure and keep pressure on the high zone. Resistance cluster around 737.6 is the line that decides whether this is a real continuation or just a late week exhaustion push. Again, the whole question is whether buyers can hold that upper trend line area, or whether this turns into another rejection. First upside extension opens around measured move target at 791.8 if buyers push through the resistance area and hold it into the close. Realistic year-end objective sits in the 775 to 780 area, but that is a bigger picture target, not a reason to ignore short-term risk. Alternate path is still very real if rallies keep failing below the high zone. Support cluster around 726.4 is the first downside test if the breakout cools off or the gap starts pulling price back. Support cluster around 726.4 is also my line in the sand for the main thesis because a clear break below it changes the read. Deeper support cluster around 693.7 becomes the next repair zone if that first support gives way. Again, as long as buyers keep holding the breakout area, pullbacks are corrective first. But below primary support around 726.4, I stop treating weakness as just a normal reset. No indicator is perfect, but the mix of strong RSI, constructive MACD, hot stochastics, and upper band pressure says the same thing: momentum is real but stretched. So the final takeaway is simple. Bulls still have the edge, but confirmation has to come through the close, and the first failed break warning is already mapped. Thanks for watching. Keep the key levels in focus, wait for confirmation into the close, and stay sharp into next week. I will see you in the next market recap.